Good morning, viewers. It's Friday morning, May 9, 2025, and I'm your host, Sunil Thakker of Sunny Talks Money. Welcome to ST Money's 7 a.m. early morning news, where we provide you the latest, concise, and precise stock market wrap with accurate figures and numbers. Please mention your email in the comment section so that we can forward you the daily market wrap in your inbox at exactly 7 a.m. Eastern Time each weekday. US stocks climbed on Thursday after President Trump unveiled what he billed as a full and comprehensive US UK trade deal and signaled optimism for upcoming China talks, boosting spirits that the tide in the global trade war has turned. The tech-heavy Nasdaq Composite rose roughly 1%. The S&P 500 climbed around 0.6%, while the Dow Jones Industrial Average also rose 0.6% or about 250 points. The S&P 500 has risen 11 of the past 13 days. The domestically focused Russell 2000 Small Cap Index rose 1.9% to close at its highest level since April 2, the day the tariffs were initially announced. Stocks came down from bigger highs in the middle of the session, but Wall Street rose for a second day in a row following Wednesday's rally as Trump said a trade deal with the UK would lead to billions of dollars of increased market access for American exports. Trump touted the deal as just the start, saying the trade talks and a tax bill moving through Congress make it a great time to invest in the US stock market. In no uncertain terms, he said, you better go out and buy stock now. Britain agreed to lower its tariffs to 1.8% from 5.1% and provide greater access to US goods as part of the deal, while a 10% baseline tariff on goods imported from the UK into the US remains in place. Under the deal, the 10% tariff the US imposed against UK goods will remain, though some products will be exempted, and auto tariffs against UK cars up to a certain number will be lowered to 10% from 25%. The UK is also committed to import more US goods, including Boeing planes. Trump outlined benefits for both countries and said the administration has done trade discussions in coming days. He said investments in the US from this and future trade deals could amount to $10 trillion. The deal is the first of its kind since the administration unleashed tariffs 5 weeks ago. Trump indicated the rest of the U.S. trading partners want to make a deal, signaling Treasury Secretary Scott Bessent will be traveling to Switzerland soon to speak with Chinese officials. The Treasury Secretary is traveling to meet China's lead economic representative, potentially paving the way for broader trade talks with the world's second largest economy. Airline stocks shot higher after the US UK deal exempted plane parts made by Rolls Royce from tariffs, with the S&P 500 passenger airlines index closing up 5.4%, led by a 7.2% surge in Delta Airlines. US Commerce Secretary Howard Lutnick said the UK would buy $10 billion worth of Boeing aircraft, sending the plane maker share 3.3% higher as the best performer on the Dow. Among others, US listed shares of ARM slumped 6.2% after the chipmaker forecast first quarter revenue and profit below US estimates. Tapestry rose 3.7% after the luxury group raised its annual forecast, while Krispy Kreme's shares plummeted 24.7% after the restaurant chain became the latest to withdraw its full year forecast. In the auto industry, Japanese heavyweight Toyota said tariffs would result in a $1.2 billion hit over just over 2 months. US peer Ford, which withdrew its guidance this week, raised prices for three popular vehicles on Wednesday. On the sector level, consumer discretionary, industrials, and energy were the best performers, while healthcare and utilities were the laggards. Semiconductor stocks ended 1% higher, building on the 1.7% rise in the previous session after a spokesperson said that the Trump administration was planning to resign and modify a rule that curbed the export of sophisticated artificial intelligence chips. Meanwhile, markets are digesting the Federal Reserve's decision on Wednesday to hold interest rates steady. Chair Jerome Powell suggested the central bank will take a wait and see approach to the policy as he underlined the economic uncertainty and market volatility created by Trump's tariff push. Trump again attacked Powell on Thursday, calling him a fool who does not have a clue. Elsewhere, the Bank of England cut interest rates. On the economic front, weekly initial jobless claims fell more than expected last week, suggesting for some analysts the labor market remains on a stable footing. But a separate report showed worker productivity dropped in the first quarter for the first time in nearly 3 years. In Thursday's other trading, benchmark treasury yields rose above 4.35%. Bitcoin traded above $100,000 for the first time in months. My take: moving too fast, slow down. Is this simply an example of the old adage that equity investors are paid to be optimistic while bond investors are paid to be pessimistic? Perhaps. But there is some justification for Wall Street's optimism. It is largely rooted in the view that economic damage inflicted by tariffs won't be as bad as feared a few weeks ago, partly because the Trump administration has backpedaled in the face of market ructions. In other words, the Trump put is back. Investors also have reason not to be too worried about the 0.3% GDP contraction in the first quarter, as it largely reflects the front loading of imports, a statistical anomaly that will be quickly reversed. It is more of a gross, distorted product. Moreover, while soft economic data like consumer sentiment indicators continue to flash red, much of the hard data like employment figures is holding up well. And according to economists, a 2.4% GDP expansion in the second quarter is anticipated. And even if real growth this year is only 0.5%, which is at the lower end of forecast, that still implies nominal growth of close to 5% if inflation tops 4%, as many economists expect. Importantly, earnings are driven by nominal growth rates. While first quarter earnings are obviously rear view mirror numbers in the context of the trade war, around 75% of the companies in the S&P 500 that have reported so far have beaten analyst expectations. This compares to a long-term average of 67%. And the 12-month forward growing growth expectations for the S&P 500 are still running at a punchy 10%. But that's not the whole story. Many firms have slashed forecasts or declined to give any guidance at all. Tariffs haven't bitten yet, but they will. Even Warren Buffett recently said trade should not be a weapon. Tariff uncertainty still runs deep. In all this, it reminds me of a cartoon character, Wile E. Coyote, who keeps on running long after the ground has disappeared beneath his feet, ahead of the inevitable moment of realization when gravity kicks in. And that's why, slow down, you're moving too fast. And that's a wrap for today, my dear viewers. And if you got value from this, please do subscribe, like, and share this video as much as possible. I will see you now on Monday morning. Have a great weekend. In the meantime, happy investing, stay inspired, and remember, it is all about money.